So Minyue Wang, so you are Director of Fund and Asset Manager Ratings at Fitch Ratings, and Anca Mandru, Senior Manager at PwC Luxembourg, so you work in the audit. So thanks for coming. So I think it's quite interesting, although we have already roughly addressed some of the issue, but to talk about the first an overview from a rating agency point of view. It's also quite important because some of the funds are rated, and also to have your view more on the accounting side. And unfortunately, we are all or very often under IFRS. So, what is the cash and cash equivalent treatment, and what are the criteria to let's say to assess this principle-based standard? So maybe Minyue, could we start with you? So just to give us maybe an overview. So you have and you can.
Yep. Sure, overview of the industry. Let me try to, there it is. Great. Okay, right. So here is a slide covering the asset development in European money fund industry. So I would like to start by saying 2023 has been a positive year in terms of industry flows. So we observed over 10% total asset increase throughout the year. And as a number of panelists have already mentioned, in terms of the size of the total industry, we estimate it to be close to 1.8 trillion euro as of end of March this year. And this slide here is basically showing the asset development by fund type. And thanks, Patrick, for the intro to all the different fund types just now. It's very helpful. So you can see, well, let's start from the left-hand side. So in 2022, we see in September, October time, there is a pickup in terms of assets. That's the UK mini budget effect in terms of lots of inflows is coming from into the sterling space. And then if we move on to 2023, the pickup is more gradual and consistent and is more notable in the public debt CNAV and LVNAV space. And if we kind of break it down a little bit, the public debt CNAV is more pronounced in the first half of the year when there was a US regional banking crisis, there was a Credit Suisse situation, and investors were kind of coming into the safest money fund type. And then in the second half of the year, we saw LVNAV continuously picking up because of the high rate environment, and it's attracting investors into the space. We estimate in terms of the breakdown of the fund type, LVNAV represent 45% of the total European money fund industry. And standard VNAV is about 1/3 of the industry, and then the rest is kind of short-term VNAV and public debt CNAV, each takes about 10% approximately. Currency side of things, the three major currency, euro, US dollar, and sterling, represent 95% of the overall, European money fund industry. And then if we look back 2023, the US dollar and the euro space, we see consistent pickup in terms of assets, whereas with sterling, first half of the year, it's more kind of a gradual outflow because of the record peak in October 2022 because of the mini budget situation. And then in the second half of the year for sterling, it's kind of like the decrease in the asset tapered out and is kind of reversed. So that kind of continued into the first quarter of this year. So hopefully that provides some kind of overview of the industry.
Very interesting. So in the reform, so they also mentioned that one of the potential ideas was to remove the LVNAV. Do you think that it would be a good idea? Because knowing the weight in the total investments?
Well, that would be a good question for investors in terms of what investors would like. But indeed, reform, I would agree with some of the panelists just now, reform is not done yet in the EU, in the global context. In the global context, it's at different stages. So here's a slide just to show where things are roughly. So as you know, let's start with the UK, the more recent developments. The consultation commenting period ended in March this year, and FCA is currently going through the process of digesting the responses that they've received, and they're working with the Treasury to come up with next step. We don't have any time frame as of now, but we do believe that in terms of that process, FCA would be taking into consideration the EU side of things, given the cross-border nature of money market funds that has been mentioned in both FCA's paper as well as EC's report as well. So that is made clear, and the regulators and authorities, they are aware. On the US front, the final rules published by SEC was in July last year, and the final round of implementation is October this year. That includes the mandatory liquidity fee. Now that has triggered a number of prime institutional money market funds announced that they would either be converting into government money market funds or liquidating themselves by October this year. So that is an area with interesting developments. And then in China, the implementation concluded in May last year, and the changes to the rule is focused on the largest or the important, they say, money market funds that defined by the fund size or the number of investors in the fund. And so far they've listed over 10 money funds in terms of who would be fitting under this category, and they are all retail money market funds. So with that, in contrast, as some of us has already discussed, the panelists, the EC report that was published in July last year kind of, concluded that money market funds passed the live stress test, and the regulation did its work in terms of what happened and how it ended. However, given what's going on in other major money fund industry, like the US and China, and also what's going on in the UK, and also the overlapping, the cross-border nature, we would expect that it's not done, and it might need to be accelerated, given that where UK is at the moment. So that's the latest on the reform.
There is a risk to sooner or later to have, with a new commission, a review of the regulation, and we will look at what the three other, let's say, major actors are doing.
Yeah, indeed. The EC actually published its expected consultation on NBFI, the macroprudential policy consultation, and then part of it is actually talking about money market fund, so in terms of the framework or any future changes. So the idea of the consultation is to get market participants' response to kind of collect them so that it can be feed into the next round of commissioners in terms of their policy plan. So yes, in terms of the priorities, there might be some shifts given the ongoing development in political scope.
No, we as corporate are really in favor of having more resilient industries, so it's great, but it should not be at the expense of the players, because we are afraid of over-concentration. As we mentioned, I've heard gates at 50%, so how do you want to extract some yield if we have to keep at any moment in time some liquidity gates? And so that could be a bit the... We are in favor and we support, let's say, regulation, providing we remain reasonable in the level of triggers we want to fix, because it could be at the expense. But when we talk to corporates, some say that providing they have daily liquidity, VNAV, LVNAV, or whatever, they don't care. So what they need is really the daily liquidity. Was it a sort of trauma from the last COVID? A lot of people are so afraid that they want to potentially get rid of all the fund at any moment in time.
Yeah, I just want to add that I would agree with that, because on our rating criteria, we don't differentiate between LVNAV and short-term VNAV, because fundamentally they're used for daily cash management, and we are expecting to see high level of liquidity if the fund wants to achieve the highest level of rating.
Maybe a question for you, Anca. So you are more the IFRS specialist. So maybe first, and I don't know if we can go further into the slides. So normally we have one or two slides to explain. When we say cash and cash equivalent, what are, because as I say, the principle-based rule, IS7, not IFRS, IS7. So what are the key criteria we should, let's say, respect or demonstrate to get this qualification?
Yes, thank you very much, François. Good evening, everyone. Glad to be here to share with you some of my IFRS knowledge. I am IFRS expert today in the room, so I am here to share what the standard says and to put it in simple terms, because already IFRS raises a lot of headache, is the fact that when we speak of cash, we think of cash on hand, and that's straightforward. But then we speak also of demand deposits. And in this respect, IFRS doesn't come to give a definition. And then it's generally accepted, and everybody, when reporting under IFRS, considers demand deposits to be those deposits with financial institutions, repayable on demand, that's very important, available within 24 hours, as we speak of on demand, and without any penalty. And only then we speak of cash. And then there is the second part, in case we are in none of these situations, we will have maybe a cash equivalent. And cash equivalent means whatever is an investment of 3 months of less, but 3 months from the date of initial investment, from the date of acquisition. And here, when reviewing IFRS financial statements, I've noticed sometimes the confusion in these 3 months, not until maturity date, but from the date of initial investment, of acquisition. It needs, of course, to be highly liquid, such investment. And when we speak highly liquid, it means readily convertible in a known amount of cash. And that amount of cash should be known at the date when I initiate the investment. So again, I always refer at date 1. I start to do an investment. Am I in something highly liquid with max 3 months up to maturity? And I know the amount redeemable already at day 1. Then I speak of cash equivalent. And another very important characteristic is insignificant risk of change in value. We spoke a lot of money market funds. There is a predilection, and I see it lately, to go to such investments. But when we do audits of multinationals with such type of investments, the high risk is the qualification of cash equivalent. It will not fall into cash, for sure, but for cash equivalent. And there are two, let's say, approaches. First is to look at the fund unit, at the money market fund unit, and there we look at the weighted average maturity, and we go back to that 3 months. Any weighted average maturity of 3 months or more, so max 90 days, will disqualify, will bring out such investment from a cash equivalent characteristic. And then to the weighted average repricing, when the investments, underlyings of the money market fund, they are repriced to a benchmark rate, interest rate repricing. Is it done often? Is it done after a longer period of time? The longer, the higher this weighted average repricing is, the higher the risk that it will disqualify from a cash equivalent. It's just that it is not a cash equivalent. It goes into another category as investment.
Yeah, we know that it's an important, let's say, feature that a lot of corporates try to demonstrate. But does it mean that this kind of exercise should be run for a listed company on a quarterly basis? Ideally.
Being listed, they should prepare interim accounts. And they come to prepare under IAS 34, the IFRS accounts. And of course, there we go and look. Have you correctly classified your investments? Have you put them in the correct bucket? Do they bring a lot of volatility? We see it in your P&L. The more the high risk of changing value, which in the end impacts the P&L, it disqualifies from a cash equivalent perspective.
But normally you should demonstrate whatever type of investment for each one that is pass the test and etc. So it's quite an heavy exercise.
Yes.
Because it's a question we had recently with the German Treasury Association VDT, and so they were asking for having a sort of automatic stamp, say, okay, if it's a AAA rated fund, if it's LVNAV, if it's XYZ investment manager behind, it should be qualified as cash equivalent, but it's not automatic, unfortunately, and so it's the repetition of tests we should
yes, and
not only for money market fund, by the way, for all the type of
all type of short-term investments.
Short-term investment you want.
And we highly encourage all the multinationals to go at each reporting date through this exercise, this critical analysis, because I've seen ESMA enforcement decisions where they highlighted these facts, 500 million being wrongly classified.
And this kind of exercise will be the same for a term deposit and a tri-party repo, for example. So we should also, what are the maximum tenor for being qualified as cash equivalent?
We always turn around 3 months. And 3 months, so the 90
so
days
if you have a deposit
yes.
over 3 months, it
yes.
will not be qualifying.
Yes, from date of, I repeat that because I've seen it in IFRS financial statements. It was misinterpreted the 3 months from the date of maturity. So they were at the reporting date within that 3 months window up to the maturity. No, it was important to look back from the date of the investment, of the acquisition.
Minyue, a question for you. So you will certainly confirm that it's good to have a rating. And by the way, you give rating, it's a bit different from the rating. It's, in your case, I guess it's AAA and then it's MMF for mentioning that it's a money market fund. So, but what type of additional information on top of the rating could you give to the users to get a better flavor of the quality and having the information for selecting the money market funds?
Yeah, sure. I have a slide, so let me, thank you.
You have a specific document that we can use?
Right, so first off, glad that you asked. So here is a slide. On the left-hand side, you can see that these are the key risk aspects that we look at when we are assessing a money market fund and providing a rating. So rating is our output. In terms of the publications we have our RAC, which is Rating Action Commentary. That's readily available on our website. And on the right-hand side, rest assured, we're not putting them here to test your eyesight, but just want to highlight that we do have these publications as well that we provide on a quarterly basis for our rated money market funds and also short-term bond funds. So from memory, we have 66 rated short-term money market funds, 11 standard money market funds, and 13 short-term bond funds. That's all included in this compare. So this compare provides you with a trend in terms of the fund behavior that's covering these key aspects that we assess, as well as a comparison with a peer group in terms of the rating level and the currency and the fund type in terms of prime or government, because there is a difference. So for those ones who's interested, have a look on our website and just type in money fund compare, it will come up. Just to quickly go through the key risk aspects that we're looking at here, because sometimes people tend to ask, you know, AAA rated money market fund, AAA rated corporate, what's the difference here? First off, money market fund rating is not a credit rating in its traditional sense. As in, credit rating is basically like an issuer or obligor that
one issuer.
Yeah, whether they have the ability to repay the financial obligation when they come due. Whereas money market fund rating is our opinion of a money market fund in terms of its ability to meet its dual objective of preserving principal and providing liquidity. So that's what we're trying to assess. So in terms of assessing that, we look at credit risk, market risk, and liquidity risk, and we've included those key measures as well in terms of how we use those to measure the risk aspects of things. And on top of that, I want to add that we talk to the managers as well. So we talk to them normally on an annual basis just to go out and understand their...
Like for a rating.
Yes, in terms of their interpretation of the market condition, how they would like to manage their portfolio, and most importantly, to make sure that we are aware of any update with the credit selection process and the portfolio construction process, and also the challenging function that's embedded within the framework, meaning that if there's sufficient risk control, risk management, and compliance system, that's with the manager. So that's why we need to meet them periodically just to assess those aspects of things. And fundamentally, we're trying to assess that the manager is capable of managing the money market funds. And normally when there's market development, we would reach out to relevant managers as well in terms of their interpretation of the condition and how they would plan to react to the situation. So with all that coming together, we can opine on the quality of a money market fund.
So the good news, it's not only based on figures and fact, you also assess the quality of the management as you would do for a corporate or assessment. So so coming back to the point Michael mentioned, so the seniority and the expertise of the management could be also a factor that you will consider and address.
Yeah, definitely. So that's part of the resources that the manager has.
So your analysis are a good complement if you want to assess the quality and demonstrate and evidence to your management that the fund you are using are good, not only in terms of performances, but also in terms of quality. Maybe a question for you, Anca. So have you seen or noticed changes in your customer in terms of investment strategies? So we talk to our members. They often come with the counterparty risk issue and what are the best practices, what are the other peers doing to be best in class. So any, let's say, behavior, things that you have noticed as major auditors in Luxembourg and across Europe?
What we notice is prudence. Maybe it's the post-COVID, as you mentioned, that everybody still maybe sits on pile of cash and waits. There is a prudent approach. There is still bank deposits, the safe way to go and to invest. We've seen a lot of attraction to ESG products, green bonds. But then we go out of the cash and cash equivalents territory, of course. We go to investments and we speak of investments. And the higher the rentability, the yield, for even if it's a short-term investment, if we speak of amounts which are not certain, a high volatility but not so high liquidity, we will go out of the cash and cash equivalent, from the cash equivalent classification, definitely.
Any final comment, Minyue, about your view on the market? So we've mentioned that reform could have an impact. Interest rate cut could be certainly welcome. Will not certainly reduce the, let's say, high interest for these products. Is it a view that you will confirm?
Yeah, interest rate side, I guess already discussed by some of the panelists, what we are seeing from our portfolio of rated fund is that portfolio managers have been selectively extending maturity of certain holdings in their fund, but at the same time, there's still sizable amount of floating rate note in the portfolio, meaning that the portfolio manager still wants to remain kind of flexible in terms of where we are going, especially in the US dollar fund and the sterling. And even with euro, I mean, we've seen one cut, but then when it's the next one, that's a question mark in the market that we're trying to understand. And also on the ESG front, let me see. Right, so we've just published, recently published our ESG kind of special report, once again, for money market funds. Feel free to have a look on our website. So two trends that I would like to highlight here. One is that we've seen a demand from regulators and also market participants for better disclosure. And that kind of reflected in the first chart top that you can see Article 8 money market funds, the total assets keep increasing in 2023, and most of these is due to conversion from Article 6 to Article 8. So it has been happening throughout 2023 still. Since 2021, I think that's first when the SFDR comes into play. Article 9 money market funds, in our opinion, is quite rare. It will stay rare because of the dual objective of money funds, you know, the liquidity provision, principal provision, reservation side of things. And then in terms of supply into the market, it's quite challenging for them to have another objective added to the existing two. But SFDR being a disclosure regulation, for anything that's marked as Article 8 or Article 9, there is enhanced disclosure. So there are a number of reports or templates that's published by managers, and I'm sure lots of resources went behind that. What I would like to highlight, perhaps for your corporate treasurers as well, is there's pre-contractual disclosure and periodic disclosure, and these are standard templates that managers need to report for their Article 8 and Article 9 products. And in these templates, you can actually find the strategy of the asset manager, as well as how the product actually performed compared to its intention that has been expressed in the pre-contractual disclosure. So that's very helpful information, although bearing in mind the latest SFDR consultation kind of review that the data availability is one of the shortcomings, and of course there's scope for enhancement, but there's definitely more information out there.
We've always had room for improvement, but okay, we are moving and certainly ahead in Europe compared to other parts of the world. So, but it's a key criterion we should let's also consider, and more, and in the future it could be maybe a compulsory, mandatory to have only ESG investments. So FX is coming, deposit could be also green, bonds you mentioned. So very interesting. So thanks a lot to the speakers, and see you in 10 minutes.